on FIRE. For those of you who are not familiar, the term FIRE, F-I-R-E, in this context refers to financial independence, retire early. But it's also worth noting that retiring early is not required for achieving financial independence. And my perspective and opinion as a younger surgeon in this group is that we probably don't talk about finances as much as we could or should within medicine. So Dr. Dahleen has been invited to join us and share some of his insight. Dr. Dahleen retired from medicine at the age of 43, having achieved financial independence several years earlier. He started Physician on Fire to enlighten, educate, and entertain other high-income professionals while discussing money matters of all sorts. He's happily married with 2 children. He calls Northern Michigan his home base, and until recently has spent much of the year traveling as a family, and hopefully can get back to that soon. So Dr. Dahleen, thank you.
Thank you for that warm introduction. And I just want to make sure you can hear me. Everybody can see me, hear me okay. I think we should be good. So I'm going to share my screen and we're going to talk about personal finance tips for orthopedic surgeons. And with the subtitle of Opportunities Unique to High-Income Surgeons. And here is my screen we will share. Okay. I didn't come up with this title, it was chosen for me, but I think I can speak to the topic fairly well. Personally, I wouldn't have put the A in orthopedic, but I guess that's your prerogative if you want to spell it that way. But we'll get right into it. First, we've got a few disclosures to cover. So I do need to tell you that I am the founder and majority owner of physicianonfire.com. That is my personal finance website. I'm also a shareholder in 2 other sites that have been brought into the WCI network, that is the White Coat Investor Network with Dr. Jim Dahleen. So I own a little bit of PassiveIncomeMD.com and the PhysicianPhilosopher.com. I might mention them during the talk, possibly. In addition, like I mentioned, Dr. Jim Dahleen, the White Coat Investor, he owns a little bit of my site and the other 2 as well. And you might be wondering why I'm here talking to you today. And it's because Dr. Dahleen wasn't available and he referred your organization to me. And well, here I am. So I'm your consolation prize. I hope you do get something out of our talk today, though. All right. I am in the upper Midwest. I was born and raised in Minnesota. I now live in Michigan because my wife is from Michigan, and happy wife, happy life. I am familiar with orthopedic surgeons from California, though. On the left, that picture is Rafi Neiman. He's a trauma surgeon in the Sacramento area. And I've spent a couple of weeks now in Honduras with he and Chris Finkmeyer and their team. On the right, you can see me in the middle there and my 2 anesthesiologist colleagues who joined them on this medical mission at One World Surgery in Honduras. We were doing paper, rock, scissors to see who got the privilege of doing big trauma cases in a rural surgery center in Honduras. And it looks like I won that day, rock over scissors. All right. I was asked not to talk too much about the basics. We do have only, 20 to 30 minutes here. Hopefully you know most of this stuff, but I do feel I do need to touch on it briefly. We're talking about financial independence. What is that? It's the ability to live your desired lifestyle without the need to earn an income. So it can be achieved by either having retirement assets that will support you, and that's usually having a nest egg of about 25 to 30 times what you anticipate spending in retirement. You can also do it by having passive income coming in that meets or exceeds your expenses, or some combination thereof with truly passive income and your net worth, your retirement assets. This is something that happened to me somewhat surprisingly. When I was about 39, I discovered this concept of FI and realized it was something we had based on relatively low level of spending. Our mortgage was paid off. I know that's easier to do in Minnesota than it is in California, but we had about 25 times what we were spending in a year in our retirement accounts and taxable accounts. And at that point, I decided, well, what do I want the rest of my life to look like? I wasn't ready to retire then. My kids were young, but I thought, gosh, maybe when they're a little bit older, we could start traveling. Kind of made a 5-year plan. And like Oren said in the introduction, retired from medicine at 43. That was 2 summers ago, summer of 2019. So what kind of things do you need to do to reach financial independence? Well, spending a lot less than you earn is key. If you live on about half of your take-home pay and use the rest to either pay off debts or invest, using reasonable assumptions of maybe 6 to 8% returns over 15 or 20 years, you'll go from broke to financially independent in that 15, 20-year time frame. I think simple investing works really well. Index funds are the cornerstone of my portfolio. I think they should be the basis of most investors' portfolios. You can certainly do other things. You can get into real estate and private equity, and we'll talk a little bit more about that. But I think keeping it simple really is an important concept to keep in mind. Another one is the fact that the correlation between spending and excessive spending and happiness is pretty loose. Now, there are certain things that we all enjoy that cost money, but it's not as strong as I think we tend to believe it is. And if you think back to college, for example, I mean, I had a blast in college. I had a lot of fun. I loved life. I had very little money. I didn't spend much money. And there are studies that bear this out as well. Once you get into six figures, multiple 6 figures of spending, you're not going to be a whole lot happier by increasing that number. The number may be even lower. You want to be comfortable, but I think, to me, I felt happiest when I was saving a lot of money, because I knew that meant a lot for my future. Like Oren said again, financial independence is one thing, retirement early is another, and they don't necessarily have to go together. So just because you have no interest in retiring early doesn't mean that you shouldn't pursue financial independence, because FI gives you options. It gives you the options to maybe try a different career, maybe do some teaching, maybe do academics. The world is your oyster. Once you have financial independence, you don't need that paycheck, and you can do what you want with your days, with your time, with your career, etc. And if that means doing the same thing that you've already been doing, great. Finally, personal finance is personal. So some of what I am saying may not resonate with you. That's okay. You just take what works, leave the rest, and we'll be all good. Before I talk about investments specific to orthopedic surgeons, we need to talk about investments that most everyone can take advantage of. And you want to do these too. You want to do these first. So you have your retirement accounts. You may have a 401k, 401a, 403b, maybe a non-governmental or governmental 457b. I can keep reading off the slide, but you can see it just as well as I do. If you're self-employed, you could have the option of a solo 401k. I was speaking with Oren yesterday. He said that he has a 401k through his employer, but he also does independent contractor work and has a separate solo 401k for that. And you can have 2 401ks. You can only make the $19,500 in contributions, and you can't do that in multiple 401ks, but you can make an employer contribution for your independent contractor money of up to $57,000 a year if you're making enough money on the side, and that would be a number somewhere in the $220,000 to $230,000 a year range. So that can really be a big boost to your tax advantage savings. You might have a cash balance plan. The older you are, the more money you can put in that. Some, in private practice, if you're in your 40s, 50s, 60s, you may be able to put away 6 figures tax deferred every year into a cash balance plan. So certainly look at all of the available options to you. Don't forget to do the backdoor Roth if you can, and most people can as long as you don't have a separate tax deferred IRA. And then beyond the retirement accounts, taxable brokerage account. That's actually where most of my money is, just index funds and other investments that I've made. that are not inside of any tax advantaged account. You can certainly invest in real estate. There are 1,000,001 ways to do that. And that's a whole nother, well, it's not just a talk, it's a conference, it's a series of books, it's whatever you want it to be. I have gotten into real estate investing in the passive way by investing in syndications and funds in recent years, just as a way to diversify my investments. Many of you are probably homeowners in California. You've probably seen that investment, even in your primary home, do fairly well, at least in terms of price appreciation. And we've certainly seen that in the last year and a half, for sure. Finally, I want to mention 529 plans. Now, I know you folks in California don't get a break on this, which is a bummer. No state tax break like most people get, but you do still get tax-free growth and tax-free withdrawals when you use that money for education. So it's worth considering if you have kids. I do have kids. As was mentioned, these are my 2 boys and my wife. People ask, what do you do when you retire early? Well, we traveled, right? And then COVID happened. Now we don't, but we're hoping to get back to it. This is Barcelona. If you've been there, you may recognize a Gaudi building in the background. I believe that's Casa Batlló. Yeah, and our kids are pretty lucky. I left my job when they were, I believe, 9 and 11 years old, maybe 8 and 10. And, they've gotten to see a lot of countries, and hopefully we'll be getting back to it shortly. So now we can talk about investments for higher income net worth individuals. We already talked about what most everyone has access to. And, there are a few definitions that are out there that may be requirements for different types of investments. And the reason these are there is, if you want to invest in certain riskier investments where you could potentially and very realistically lose every dollar you put into it, the government wants to make sure you have enough money to lose, right? So these are going to be typically higher risk, potentially higher reward. And the most common will be those for the accredited investor. You'll see that quite often if you do look into any sort of crowd-funded real estate investment, syndication, which is more or less the same thing, private equity, hedge funds, et cetera. We'll talk a little bit more about that on another slide. But having $1 million in net worth outside of your primary residence, or as an individual of $200,000 in income, or $300,000 as a couple. I would guess most people that are listening today do meet at least the latter definition, maybe both definitions. You can also find investments that require you to be a qualified client or qualified purchaser. There are more complicated definitions, and it can get a little bit complex with family offices and trusts and different entities that come into play. But for simplicity's sake, a qualified client is someone with a $2.1 million net worth, qualified purchaser, $5 million. And I have definitely invested in some different investments that require that accredited investor status. Now, what kind of opportunities are these? Hedge funds. You may be familiar with these. You've probably heard about them in the news. Warren Buffett famously made a bet with hedge fund managers that the S&P 500 would beat them over the course of 10 years. And he was right. They did. These tend to charge on a 2 and 20 model. That's a 2% of your assets under management plus 20% of the profits. They don't share in the losses, only the upside with investors, and they are incentivized to take risks. All that being said, some have done very, very well and have made minor celebrities out of their managers, but many hedge funds have not done so well. I have not personally delved into this space. Next, we have venture capital and private equity, which, it's investing in startup companies. Lots of this happening in California, especially in the Bay Area, but in other areas as well. You don't necessarily have to be accredited to invest in a private company. There are angel investing opportunities for everyone via different platforms and such. But you will see more opportunities if you are that accredited investor. And then we'll get into real estate syndications and crowdfunding. Those are really two different words for the same thing. It's finding money from groups of people. When they call it syndication, that's often done by word of mouth, personal connections, networking. Crowdfunding is basically an internet platform that helps do the same thing, find investors to pool their money together to purchase a large apartment complex, mixed use building. There are debt and equity deals, all sorts of things, whatever you can imagine, farmland, etc. There are opportunities out there. And then there are real estate funds, which are basically pooling together these types of opportunities so that when you invest in the fund, instead of one particular deal in La Jolla, California, you're investing in Texas, Florida, Indiana, Montana, etc., all in one fund. So it's kind of like a mutual fund, a basket of real estate investments that are put together by professionals. And there are some fees associated, but they can be, I think, a good way to get into real estate in a very passive way while being diversified and maybe lowering your risk a bit by doing so. This is, and I'll kind of be quick over these. I like to throw in some family slides, but this is a hike that we've done a couple of times of La Bufa, which means the bluff, over Guanajuato, Mexico, which is a very, very scenic and picturesque city in the mountains, obviously, that we spent about 10 weeks in over the course of 2 trips, and we plan to go back for about 5 weeks in September. Hopefully our 10-year-old will have at least 1 dose of his vaccine by then. So that trip isn't set in stone, but we're hopeful. Back to the scheduled program. Specific opportunities just for you, orthopedic surgeons, other surgeons, these can be awesome. They can be not so great. You really need to do all the due diligence that you can, get all the data that you can find. Usually these types of investments, which include, surgery centers, imaging, lab, for-profit hospitals, all that sort of thing, they tend to come to you because you're a partner, or maybe you, have a surgical block at the surgery center. You're an insider in some way. And so there should be other insiders that are already invested. Find out as much as you can from them before you really consider putting a lot of money into these. What are their true returns? How are those returns taxed? Does this open you up to any additional risk if the surgery center were to be sued? Are your personal assets at risk, for example? What are the threats to the profitability of this particular investment? If a surgery center were about to open up down the road, or if Kaiser Permanente were to pull that imaging center from their pool that they'll reimburse, know what those things are, because the biggest risks are the ones that we don't see and don't think about. Do your best to dig deep. Is there an exit strategy? Is there any liquidity? Can you sell your shares if you decide you need this money that would be better suited elsewhere? So a lot to think about there. Definitely some people do extremely well with these, but there are losers too. Again, it can be high risk, high reward, and there's no real good way to just lump them all together, because every individual opportunity is going to have its own facets that you'll want to learn more about. Another way I've seen, and this has been common in anesthesia in the last 5 or 10 years, but private equity coming in and buying out a group. I put seller beware there because, well, these tend to work out really well for the partners that are nearing retirement. They might get $1 million or $2 million payout to really, jumpstart that retirement process. But if you are a young partner, it may not work out so well. And their goal, these are really leveraged buyouts by private firms whose goal is to make the business more profitable, usually by cutting costs and finding other ways to make money. So these younger partners may be taking a pay cut. Now they do get that one-time payout that helps, but the long-term outlook may not be so great for them. And if you are not yet a partner and just about to become partner, 1 week or 1 month can be the difference of that 6 or 7 figure payout and nothing. So again, lots of ins and outs with those. And then again, I'm talking about specific opportunities for orthopedic surgeons, but don't forget about the ones we talked about earlier. Always start by filling out your tax advantaged accounts. $1 deferred in tax is better than paying it now. You can make money on the arbitrage there. So what have I done personally? I was an anesthesiologist. I have invested in real estate. It ends up currently being about 20% of my portfolio, mostly through crowdfunded platforms and syndications that way, and some real estate funds now. I personally don't own any cryptocurrency. I know that is a hot topic lately, and we saw Bitcoin drop about half of its value and now bounce back to, I think, 40,000. Long story short, I don't own crypto. I did invest in a cryptocurrency platform that has not gone public, but plans to in the next year or two. So that's one way that I've decided I can be exposed to that market without necessarily taking the risks of owning crypto and maybe having somebody get hacked or losing my password or my key or whatnot. I've invested in Republic.co, which is a company that helps crowdfund other startups. It's kind of a meta investment there. But I have not had the opportunity, anesthesia doesn't get asked as often as you guys, to invest in any medical office building, surgery center, hospital, imaging, lab, etc. So I can't speak too much to that beyond what I already have, at least not from a personal experience point of view. And some of this I consider play money. Now, as I mentioned, I reached financial independence 5-6 years ago. By the time I retired, we were at about double what I figured we'd need to be financially independent. So I have what I consider play money that I can take bigger risks with, because I'm not counting on this money to fund my retirement. And I think that's an important distinction when you start to look at investing in a cryptocurrency platform or a startup and these sorts of things. You can lose all of your money, and that might happen, but that's not going to derail my retirement plans. California, you probably recognize the Seven Sisters. That is not a stock photo. That is one that I took the last time I was in your lovely state. My wife and I also went up and saw the redwoods in north of town, visited some breweries up in wine country, and had a really nice time. So we've got not much time left. It looks like a couple minutes on my clock, but I'll quickly talk about some retirement topics, and then I will jump over to the breakout session, and I'll be available for the next hour. So I already mentioned becoming financially independent. That means having 25 or up to about 33% times your anticipated spending. That equates to a withdrawal rate of 3 to 4% when you start out in retirement. Now, when you look at how you're going to fund your retirement, if you have a deferred compensation plan, 457B is one type. Some people have access to the NQDC, non-qualified deferred comp. You want to figure out how are you going to set that up. I just started collecting $4,500 a month from my 457B, and there's enough money there to last about 5 years with that. And then I've got, I don't need to talk about my stuff. We're here to talk about you and your potential. So 401k withdrawals, you can actually start when you're, if you leave your employer when you are 54, in the year you turn 55, you can access that 401k. You don't necessarily have to wait until you're 59 and a half. If you are still working when you leave your employer, there are opportunities after retiring to do some creative tax planning, lower your eventual RMDs, maybe do some Roth conversions, pay some taxes in the low tax brackets while they're available. Don't forget to turn in your pager. I know that was a wonderful moment in my retirement. We had a nice retirement party too, don't forget that. So preparing for it, real quick, you have to buy health insurance. How do you do that? You buy it. It's pretty plain and simple. There are other options like health sharing ministries and different things that people do, but right now I'm buying health insurance, about $1,000 a month. Term life insurance, disability insurance, you shouldn't need them. They're superfluous. Umbrella insurance, well, you've got more money than ever. So yeah, you want that. Asset protection is important. Do some estate planning. Regarding Social Security, if you are in good health, you're probably best off delaying to age 70, but that can be a fairly complex calculation, and it will involve your spouse as well. All right, back to our travels. We like to take our kids when we travel now. When they were a bit younger, we went to the Louvre, and they stayed entertained by recreating statues. Good times. All right. There are certainly non-financial aspects of retirement. Your spouse, are they going to retire? Are they working now? What do they feel about you being home? Are you going to drive them nuts like I do with my wife? Possibly. You know, it's good to have hobbies. People do fail retirement. You want to retire to something, find purpose, have a social life. A lot of people, most of their social life is the interactions they have at work. So make sure you have something beyond your work friends to call friends. And then another way to find purpose, you know, maybe do some charitable giving, volunteering of your time. I've been giving COVID vaccines throughout Northern Michigan since January. And it was a week or two ago that I was lucky enough to be able to vaccinate my son. That's the kid in the vaccinated shirt. And he's smiling under that mask in the second picture, I promise. So